Welcome back to the channel. My name is Brad, and today we're going to cover Stretch, STRC from MicroStrategy, and we're going to do a real quick review of their preferred stocks. If that is what you're interested in, stick around. So my name is Brad, and I've been retired now for some time, just over a year, and I look at this new stuff, and I just want to bring out what strategy's been doing, what concerns I've always had, and I still have with some of the MicroStrategy preferred stocks. I love what they're trying to do, just a little more skeptical than others. But they came out with several already. This will be number 4. You got Stark, Strife, and Stride, right? They've all done fairly well in price, but they all fit different investment needs. And that's where Stretch actually can fit into my personal portfolio because this is an investment need for me. Now, they did a very good job in this PowerPoint presentation, and I'll point out why some of these others aren't for me, but they might be for you. That is all independent of your strategy, get it? Strategy, and what your goals are in your investment. Something that we should look at is over time, their yields have come down, and they should have come down. That is probably correct. Price goes up, yields go down. Now, strategy has really left it to the market to price out their interest rates in the past. This is all in the past. These first 3 funds, not credited or rated by any agency. This is market driven only. And we'll just throw our hands up and say, that brings in a little more risk and a little more, let's make sure that we understand what's going on before we just jump in, because you don't want to lose your money or anything else in retirement, like myself. We're not going to beat up strategy about this, but that's what they did. They brought it out, and none of these are credited, rated by any agency. Matter of fact, I'll just go ahead and point out that strategy was at one time rated as a company, and it was not rated as institutional grade as a company. They have recently, about December, got no rating from any credit company. Just pointing out that, if the underlying company is not rated, well, you just got to make sure you wonder about what's going on with the company. Now, they're trying to become a treasury company, and I get it. And they're bringing these new instruments to the market, and you really can't rate a treasury company because this is new. This is totally new to the market, totally new to investors. This one, Stretch, interests me because it falls into what I am looking for in retirement. It's a senior preferred security offered with a variable monthly dividend designed to maintain stable price. Well, what does this sound like? Well, kind of sounds very much like something like SGOV, or one of these other investments. JAAA, this really sounds like, hey, this is something that you can hold cash in short term and collect a decent interest rate on. Better interest rate than others. And we're going to get into that interest rate. So they're going to come out on the initial offering and say, hey, at $100, we're going to pay you a 9% interest rate, and the expected BTC ratio at IPO is 7. And that's a very interesting comment per strategy, because I'm going to point out at the end of the video why that even makes you scratch your head even more. But they're going to come out with $500,000, and they're going to bring it out this week, because I went to Fidelity. The pricing will be released on the 24th, and that will probably be right around the same day that it goes public, because Fidelity is offering it. Just to let you know, you can go out. But they did have a lot of stipulations on there that made me scratch my head even more. For me, I've always been saying no long-term treasuries. Stark, well, they're comparing Stark like a long-term treasury. Well, okay, now that eliminates that one right off the get-go. If you're going to compare yourself to something I wouldn't hold already as long-term treasuries, then why would I hold your preferred stock? That's just me. Strife, they have a duration time period of that 12 years. Oh Christ, I might not be even around in 12 years. You know that you're going to be alive tomorrow? I don't think you do. Now, Stride, that's a shorter duration. It's still longer than what I want for some type of income from this type of product. Now, STRC is going for that shorter term where those leveraged loans are. And Brad invests in CLOs. Guess what? CLOs are leveraged obligated credit. And that is where this is going to start playing in. So hey, you're going to get me a higher interest rate? Now I'm interested in this. So let's continue on this great journey of what stretch really could mean for you. First of all, I've always been a skeptic. I've been called out as a skeptic. So let's use their Skeptic Matrix because that is where Brad falls into everything. I'm a skeptic about everything because if you're not a skeptic about everything, then you're just kind of being foolish. Personal opinion. Yeah, I did call you a fool if you're not skeptic. Hey, the BTC risk, and that is something that I actually believe in, is on this one, 11.32. That is something I get because they're assuming BTC annual return rate of 0%. Keep that in mind because that is what I pointed out on the next basis. Hey, what is the sequence of return risk? What happens if there's no annual return rate of Bitcoin? Now, the other one here is they said 17,000. Well, we're going to get into that one as we go through too, because what happens if the price goes down? That is a better, interesting conversation. But for those maximists that Bitcoin is only going to go up and never have a correction ever again, and it's got a 30% annual return rate annually, hey, everything's good. There's no BTC risk. That is personally being a little foolish. There's always risk with investments. And anybody that thinks there's no risk with any investment, well, we'll just go ahead and say, please remove yourself from being under a rock because there's always risk with every investment. But if I'm going to take this same consideration, you also put the convertible debt into play. Now your BTC risk is 18.41. That's at a 0% annual return rate. Oh, let's quickly think about this. What happens if Bitcoin goes in half? I've already said, hey, it's going to be about $70,000 is the floor. Then that only brings you up to, the low 30s in BTC risk. Okay, I believe in BTC. I think that's not that bad of a actual deal. That risk is low enough for me to say, I'm in. Or will I be in? Because I might not be in because they might not let me in. That's going to be an interesting one later this week to see what happens with them. Now, this is the seniority and volatility of the security. The stretch, STRC, is supposed to be not very volatile. It's supposed to be between 99 and 101. And they're going to try to keep it in that price range. Stride, well, that's going to be a little more volatility because it's farther out on that matrix. Strife, again, more volatility. And Stark, well, that's supposed to be, and of course, MSTR is the most volatile of all the products. So here you have a very non-volatile product that's going to pay you around 9%, but that is actually going to be, it's going to be based on SOFR, the Secure Overnight Funds Rate. Now, as they lower interest rates, SOFR is going to go down. That's going to affect my CLOs. And that's why I'm looking at this. can I maintain a 7 to a 9% annual return rate on my cash in retirement? That is why I'm really interested in Stretch. So basically what they're saying is hey, Strife is more related to the 20-year treasury. And Brad's already said no 20-year treasuries for Brad, not my investment. Where Strike is on that 1 month treasury. That is more my speed. And hey, they're going to come out between the 95 and 99. So you can see that, hey, they're going to give you a good yield on your actual cash. They bring out that, hey, as the secure overnight funds rate goes down, you can expect Strife to raise in price. Well, that's not exactly how it works. And I'm wondering who has the degree now in finance, because long-term treasuries are also influenced by inflation. And they did not point that out. So you can hold them to this, because this is their presentation saying Strife will go up in price as SOFR goes down. Well, that's not taking into consideration inflation, because 20-year treasuries and anything beyond a 10-year treasury has an inflation factor into it. Just keep that in mind. That's why I always take things with a grain of salt. The 1 month is definitely correlated to the secure overnight funds rate. As you see, SOFR goes down, you're going to see STRC, percentage and yield, go down with it. Normally, 1 month treasuries actually work this way. So I fully agree with their chart here. And that's why I'm more interested in this product than the other 3 products that they already have come out. And again, this is on your goals, not my goals. My goals are in retirement, and what am I going to do with my cash? And that's where I'm looking at this fund. Maybe it's something for me to get into. They gave some examples. They gave the example of money markets, paying about that 4.2%. Wow. Now you can make 9 short-term treasury bills, 4.3. Well, that's about where they are. Look at SGOV. Bank accounts, well, you just forget about those. Stable coins, well, that's a different subject matter. Corporate paper, 4.3. Hey, that's about right. So they're going to pay you about 4.3%, thereabouts, on their yields for some of these funds. Now, this is in consideration. These are actually short-term products. Gets you about that 4%. But we know that the secure overnight fund rate is going to go down, so you can expect your money markets to go down. And when it goes down to 2%, do you really want your money in a money market or something maybe earning 7% like Stretch? Just pointing out the difference of the funds. So the 15th of every month is the date of record. This is when you will have to be the holder or the owner to actually get paid. Then at the end of the month, they're going to pay you, and they're going to announce the next month's rate, and then you have to hold it on the 15th for the date of record to be able to get paid again at the end of the month. So how big is this market that they're actually going after? You can see that this is a significant market to go after. Their initial offering is only 500 million, but they're going after stuff that's in the trillions. Money markets, $7.4 trillion sitting in money markets. And we know that when they cut the rates at the Fed, that secure overnight fund rate will go down, and your money market account will pay you less and less every single month. Where are you going to put your money in the future is up to you. But here is an opportunity to earn that higher interest rate. So what mechanics are in place to keep this within that $101 to $99? As the price is below $99, hey, they can increase the dividend rate, right? And they can cease selling STRC ATM. That makes sense to me. Don't sell any more shares, raise the interest rate. That will cause the price to go up. How do they keep the price from going up too high? Well, they can decrease the dividends. They can have a second offering, do a lot of other stuff. They can call back at 101. Now, if they call back at 101, here's a little stipulation of this. You also get all the interest earned for that month, plus the 101. Keep that in mind. That was something in their prospectus that they pointed out. That, hey, they called back at 101, but you also earned interest. And they're going to pay you at that accumulative interest also. Some other major factors, but difference between Stripe and Stretch. Cumulative initial rate is higher. They're both perpetuals, but here's the rankings. Stripe is senior to Stretch, Strike, and Stride, and Common Stock. So keep that in mind that we are one step below in the pyramid. I also like to point out some little details in the fine print at the end. They are not required to hold any assets to actually back Stretch. Huh, wait a second. No Bitcoin? What do you mean they have no Bitcoin to back this? Just pointing out, they are not required to hold any assets to back this stock. It's in the fine print. Don't yell at me. Will they hold Bitcoin? They say they will. They won't allow you to have the addresses to verify that. That's been pointed out more than once. They think it's a security risk. Wait a second. Bitcoin's a security risk all of a sudden. Having addresses are a security risk. Interesting. Yeah, I thought it was supposed to be something there unhackable. How can it be a security risk if it's unhackable? Well, sometimes these CEOs talk out both sides of their mouth. Just pointing out that, hey, if I can't verify it, then it might be something to be a little more skeptical about. And I'm always skeptical. Now, they are third-party audited, or are they? They should be third-party audited because they are a public company. And if the third-party auditor says that, hey, they hold this Bitcoin, then I'm going to believe them. That is where I am at in the believability fact. Now, one final comment. So I went out to Fidelity to see this whole, why does it say some investors? And that gets us into this little fine print. It's going to be for somebody that holds 10K in retail brokerage assets. Huh. That's interesting. So you may or may not be able to hold this in an IRA or a Roth, but you could hold it in a brokerage account for retail. At least that was the information that I received. Now, when I asked about the initial public offering, well, they started pointing out that you had to have $500,000 in your brokerage account to even participate in the IPO, according to Fidelity. Again, only reporting the information that's available on the Fidelity website. Now, final closing comments. I am actually interested in this. Hey, if sulfur goes down, which it will because they're going to lower interest rates, the lower interest rates they go, less I'm going to be able to make on my cash. I'd like to see my cash making at least 5%. And according to their chart that they provided, if interest rates go all the way to zero, they're going to be paying about that 5% range. That is something I'm interested in retirement because, hey, my cash can be making 5% and everybody else is making nothing, then I'm doing a whole lot better than the average Joe investor. That is why it's interesting to me as a retiree. Can this really be something that I can invest in? It's senior tranche, but below all their debt, convertible debt. I think it's reasonable that this could be something that you can hold your cash in to make a decent interest rate as sulfur begins to decline. Everybody wants the interest rates to go down, but it's a little more worried about interest rates with CLOs because that's going to affect their interest rate and what they're able to pay me. So it's one of those, might be a good time to switch to something like this so I can still collect a decent rate as sulfur goes down with the Fed cuts. So until next time. God bless.